Your 401k might be costing you more than taxes, more than inflation, and you don't even see it. We're talking tens of thousands, sometimes hundreds of thousands, just quietly disappearing over time.
401ks are an employer-sponsored retirement plan, one part of the three-legged stool of the U.S. retirement system.
I think that's a harsh reality for a lot of people.
If you make $100,000 a year, you need $1.5 million to be okay.
A lot of 401k programs are lousy.
You put up 100% of the capital, you take 100% of the risk, and you get 30% of the return.
That's a question that can only be answered on what your risk appetite is. If you
This isn't making it simple.
I wish it was simple.
And the craziest part, this is completely legal, built into the system, and most people never question it. So the real question is your 401k actually helping you retire, or slowly making you poorer? The math gets ugly fast. Most people think their 401k is just growing in the background. But what they don't realize is there are multiple layers of fees quietly pulling money out every single year. Not one fee, not two, usually 5 or more. And here's the part nobody tells you. You don't actually see them. They're not billed to you. There's no receipt, no notification. No, you paid this much in fees email. It just shows up as lower returns. So if your investment's made 8%, you might only see 7%, or even less. And you'd never know why. Now that might not sound like a big deal until you realize what that does over time, because these fees stack. You've got expense ratios, and those are taken directly out of the fund before you ever see a dollar. Then there are administrative fees, record keeping, accounting, legal, just for maintaining the plan. Then you've got management fees, you're paying the people running the funds, and sometimes even marketing fees. Yes, you're paying to be sold the investment you already own. And here's the trick. Most of these don't show up clearly on your statement. They're buried inside the returns.
Mutual funds were charging high management fees, but nobody seemed to care.
The returns are great, so no one thinks about how much is this costing me when they're earning 15 or 20%.
So instead of seeing a bill, you just grow slower. And that difference is massive. A 1% difference in fees doesn't sound like much, but over a 30-year career, that can cost you hundreds of thousands of dollars, sometimes more. Money that could have stayed in your account just quietly disappears, and most people never even realize it's happening.
The United States is definitely facing a retirement crisis.
I'm not wanting to be rich. I just like to have enough to where I could be comfortable.
Now let's talk about what that small 1% actually does to your money, because this is where it gets uncomfortable. Let's say you've got $25,000 in your 401k at 35, and it grows at around 7% a year. Sounds reasonable, right? With low fees, around 0.5%, you end up with about $227,000 by retirement. Not bad. But bump those fees up to 1.5%, just 1% higher. And now you're sitting at about $163,000. That's not a small difference. That's $64,000 gone. Same investments, same market, same person, just different fees. And that's without adding another dollar. Now let's make this more realistic, because most people are contributing every year. Start with $50,000. Add $6,000 a year. Let it grow for 30 years. With no fees, you're at about $1.5 million. Feels like the system is working, right? Now add just a tiny fee, 0.25%. Your balance drops by over $100,000, from something most people would call basically nothing. Now push that further. Add another 1% in fees over time, and suddenly you're not losing a little bit. You're losing over $500,000. $500,000. That's not a fee. That's a life decision. That's a house, paid in cash, that you never get. And here's the part that should bother you. This isn't rare. Depending on your plan, total fees can range from under 1% to over 3%. So two people, same salary, same contributions, same market, can retire with completely different outcomes just based on the plan they were put into. And most people don't even know which one they're in, because remember, you never see a bill. You just grow slower. And over decades, that slower quietly turns into hundreds of thousands of dollars. That should have been yours. The system isn't broken. It's working exactly how it was designed to, just not for you. When you see a fund charging something like 1.2%, you probably think, okay, that's just what investing costs. But that number is doing a lot more than you think. You're not just paying for someone to manage your investments. You're paying for an entire chain of people behind the scenes.
The money managers always want more, and that's natural enough in most businesses, but it's not right for this business.
Record keepers, brokers, insurance layers, sometimes even marketing. Yes, you're paying to be sold the investment you already own. And here's where it gets interesting. All of that gets bundled into one number. It's called revenue sharing, but you'll almost never hear that term unless you go looking for it. Because it's not shown clearly, it's not broken out. It's just quietly built into the fund itself. So you never see a bill, you never see a charge. There's no moment where you say, wait, why am I paying for this? The money just moves from your account to everyone else in the system. And what do you see? Lower returns. That's it. Now this is where it becomes obvious and a little uncomfortable. The exact same fund can have completely different versions of itself. Same stocks, same strategy, same performance target, but different fee structures. Some versions are loaded with these extra costs, others have none. Over the last decade, those lower cost versions beat the higher cost ones by over 1% per year. Same investment, just fewer hands taking a cut. And that difference compounds into a massive gap. Not because one manager is smarter, not because one fund is better, but because one is cheaper. That's it. And here's where it really separates people. Large companies, they don't play this game. They get access to institutional level options, lower fees, cleaner structures, no hidden layers. But smaller companies, that's where most people are. And that's where these extra costs show up the most. So two people doing everything right, saving the same amount, investing in what looks like the same fund, can end up in completely different places just because of the plan they were given. One keeps more of their money, the other slowly leaks it out, year after year, without ever realizing why.
So I pulled out my annual report and we kind of compared notes, and I realized that he was doing far better than I was.
By law, your 401k is supposed to tell you exactly what you're paying. Sounds reassuring, right? Like the system has your back. But here's what actually shows up. A disclosure document, usually 10 pages, sometimes more, packed with dense financial language, numbers scattered everywhere, fees split across different sections, buried in footnotes. It's not one clear number. It's a puzzle, and most people don't solve it. They open it, skim a page or two, see a wall of text, and move on, or they don't open it at all. And even if they try to understand it, it doesn't really help. Because the way it's written isn't designed for clarity, it's designed for compliance. There's a difference. A government report found that nearly half of people don't understand the fee information, and about the same number don't even realize they're paying fees in the first place. Think about that. You're required to be told what you're paying, but most people either don't see it or can't make sense of it. So technically, the system is transparent, but practically, it's not. Because when you get a 10-page document filled with legal language and no clear answer, you don't feel informed, you feel overwhelmed. And when people feel overwhelmed, they do nothing, which is exactly what the system needs, because as long as you don't question it, the fees keep flowing year after year, quietly, consistently, without resistance. And here's the part most people miss. This isn't a mistake. The disclosures exist, so providers can say they told you, not so you actually understand it. So you get compliance without clarity. You get disclosure without understanding. And while you think everything is being handled for you, your account is just growing a little slower every single year, all right. So what do you actually do with all this? First step, get your hands on your fee disclosure. By law, your plan has to give it to you. It's usually called a 404A5 disclosure. If you've never seen it, that's normal. Most people haven't. Check your plan documents or just email HR and ask for it directly. And don't let them brush you off. You're legally entitled to it. Now when you open it, don't panic. It's going to look like a wall of text. Pages of legal language, numbers scattered everywhere. That's by design. So here's the shortcut. Ignore 90% of it. Look for just 3 things: the expense ratio of your funds, any administrative fees, and whether there's revenue sharing. That's it. Add those up, that's your real cost. Now here's how to think about that number. If you're under 0.5%, you're in a solid plan. Around 1%, you're starting to lose meaningful money over time. Above that, you need to pay attention, because the difference between 0.5% and 1.5% isn't small. It's hundreds of thousands of dollars over your lifetime. Same effort, Completely different outcome. Now, if your number is high, don't just accept it. Take it to HR. Ask them simple questions. Why are our fees this high? Have you compared this plan to others? Are we using the lowest cost options available? And here's the one that gets attention. Are we meeting our fiduciary responsibility? That matters, because legally, they're supposed to act in your best financial interest. And companies have lost lawsuits over this exact issue. So yes, they care when you ask. Now here's what you can control immediately, inside your plan. Choose the lowest cost funds available. Look for index funds. They're usually the cheapest option. Be careful with anything labeled actively managed. Those almost always come with higher fees. And this part is important. Don't chase past performance. The best performing fund last year often becomes the worst decision long term. Cost matters more than almost anything else, because fees compound just like returns do, except one works for you and the other works against you. So is your 401k actually worth it? The honest answer is yes, but only if you understand how it works, because a good 401k with low fees and a company match is still one of the easiest ways to build wealth. That's free money, plus tax advantages working in your favor. But a bad 401k with high fees, limited options, and hidden costs can quietly cost you hundreds of thousands of dollars over your lifetime. Same account, completely different outcome. So the real move isn't to avoid your 401k, it's to stop being passive with it. Know what you're paying, choose low-cost funds, and make the system work for you instead of against you. Because at the end of the day, this isn't about percentages, it's about your future. And the difference between doing this right and doing it blindly could literally be hundreds of thousands of dollars. So the question isn't just, do I have a 401k? It's, is it actually worth it? If you want to understand how to actually build wealth and not just follow what everyone else is doing, subscribe. And check out the next video on your screen, because it breaks down another money decision that could be costing you way more than you think.